What we're looking at is the euro-dollar 5-minute chart last Friday. Now, the white vertical line represents 8:30 a.m. Eastern when non-farm payrolls was released. Now, if you recall, last Friday, non-farm payrolls, I believe, was expected at around a loss of 125,000 jobs, if I'm not mistaken. Now, the actual number was a loss of only 11,000 jobs. Now, putting aside fundamentally for a moment what this means, obviously job losses are not, job gains are better than job losses, and we still have job losses. But putting all that aside, the fact of the matter is the market, overall, the market was expecting a loss of 125,000 jobs. The number was much better than what was expected. The loss was only 11,000 jobs. Now, in addition, the unemployment rate was expected to remain unchanged last week at 10.2%. The unemployment rate that actually came out was 10%, although still not good at all, better than expected. Now, we would then likewise expect the market to react in a certain manner according to the data that was released. The number was better than expected. Now, what does this mean towards the U.S. dollar? Because the non-farm payrolls, the U.S. number, obviously has the greatest connection to the U.S. dollar in the foreign exchange market. Well, better than expected non-farm payrolls, better than expected unemployment rate certainly would lead a lot of us to believe that, well, this is better than expected, the data is better than expected, and maybe the Federal Reserve, the FOMC, one day will sooner rather than later raise interest rates. Why is this important? Because we know the number one reason why currencies move is the expectation of higher or lower interest rates in the near-term future. Now, I don't believe the Federal Reserve will raise rates anytime soon. I'm sure most of you probably don't think that either. However, the market perception is always trying to balance, do we think it's going to happen much later or sometime in the future? Is it better than expected, which number was? Well, then that leads us to believe that maybe the Federal Reserve will raise rates a little bit prior to than what we had expected prior to the number. At any rate, this chart makes sense. What we do is we measure, the vertical line again represents 8:30 a.m. Eastern, and we mark off the lows and the highs that were achieved during the first 15 minutes of the trading after or following the release of the big economic number. And we can use this technique for non-farm payroll, CPI, PPI, GDP numbers, central bank meetings, tanking, you name it. Any large market-moving number, we can use a strategy. I call it a 15-minute cooling-off period strategy because what it allows us to do is it allows us to let the market cool off around 15 minutes. The rationale is during the first 15 minutes following the release of a very significant economic number, there's a lot of buyers and there's a lot of sellers that jump in and out of the market, and the trading action can be somewhat random. However, if we look for the breakout following that 15-minute period of initial randomness, then the subsequent breakout, I think, can be much more indicative. If the market immediately goes down, and we'll see in the next chart how this was a little deceiving, if the market immediately goes down, we can say, hey, non-farm payroll is better than expected, sell short the euro dollar. Well, in this case, that trade would have been correct. However, that's not always the case. Sometimes, I'm sure you've seen, there's an initial spike lower and then a reversal back up higher. That's why, again, we wait for the 15 minutes. Now, again, vertical line represents 8:30 a.m. Eastern, and the bottom line represents the support or the lowest level the market was able to achieve during the first 15 minutes. There's a 5-minute chart, so we use 3 5-minute candlesticks. For number 1 candlestick is on that white line, 2 and 3. That measures low to high the first 15 minutes of the euro dollar following the release of the non-farm payrolls from 8:30 to 8:45 a.m. Eastern. Well, the low of that was 149.76 and the high was 150.78. Now, the next step in the strategy is then to look for 3 consecutive 5-minute candlesticks to close below support or above resistance. Why 3? Well, sometimes we can see 1 or 2 candlesticks drift below and back above the support level or resistance level, and that certainly is not indicative enough. I like to use 3 as a rule of thumb to get a little bit of a better idea where the market could probably go. And I also want to wait for the closing period of that candlestick, meaning the thick part of the body. For example, if one of the prior candlesticks had jumped down, had fallen below 149.76, the support level, and had traveled back up, I would disregard that long candlestick wick. That did not happen. However, that's what we want to do. And the final step in the strategy is to place our protective stops, ideally on the other side of the entire range. The low is 149.76. The high is 178. That was about a 102 pip range from low to high. Not always will we see a 102 pip range. Sometimes we'll see more. Sometimes we'll see much less. However, as a rule of thumb, if there's less than a 30 to 50 pip difference between the low to high, if it was 149.50 to 150, about a 50 pip difference, that's okay. Much less than that, well, I don't like to use those charts and take those trades because if the market didn't have a very violent reaction, it tells me that not a lot of traders are maybe involved in that particular trade at that time, or maybe there's just not the kind of momentum that's needed to carry the market into a future trend. Well, if we scroll forward this Eurodollar 5-minute chart, we can see we finally broke down. We count 1, 2, 3 candlesticks. The green candlestick, ironically, is actually the third candlestick that closed below support. Support was 149.76. The highest highs we saw after that were 149.63, which is about 13 pips lower than that. And as we scroll forward, we see the Eurodollar. Actually, I'll zoom out a little bit here. And we'll see the Eurodollar subsequently made a move much, much lower, actually hitting lows of 148.21. That's about 150 pip sell-off from that breakdown. Well, we scroll forward, and then the Eurodollar, we can see, has now continued in its downtrend, hitting lows of 147.55 actually yesterday. This was a very nice day trade or long-term trade, depending on our point of view, because the Eurodollar formed our 15-minute range, broke down, never tested our support, never tested our resistance, and just kept on going. This is ideally what we want to see.